Soumya Subi Joseph, the student of PGP LSM, to formally introduce and invite Ms. Bindu Ananth, CEO, Dvara Research. Soumya.
A very good evening to everyone, and I hope you all are staying safe and keeping well. It is with great pleasure that I welcome everybody to the 8th session of the Finance Lecture Series 2020, presented by IIM Kozhikode. Today we have with us Ms. Bindu Ananth, the co-founder and board chair of the Dvara group of companies, which includes Dvara KGFS, Dvara Solutions, Dvara Research, as well as startups including Dvara Money and Dvara Gold. Prior to this, she was part of the founding team of ICICI Bank's microfinance division, which launched several pioneering products and eventually emerging as a market leader in rural, agricultural, and micro-lending. Ms. Bindu also has an undergraduate degree in economics from Madras University and 2 master's degrees from the Institute of Rural Management Arnold, Financial Engineering for Low-Income Households. It's a pleasure to have you here, ma'am. In today's session, Ms. Bindu Ananth will share her insights on the possibilities of innovations in household finance, drawing upon her vast experience in the field of microfinance. Today's session would be moderated by Professor Ashok Thomas, Professor of Economics. We extend a warm welcome to both. Now, I would like to request Professor Ashok Thomas to take the session forward.
Thank you so much, Soumya, for the lovely introduction. I don't go for, again, the formal introduction to Ms. Bindu Ananth. In fact, I would like to set the context of today's presentation. Why we have the best person, Bindu Ananth, here. I would just love to had a thought on this. Now, as students of finance, you might be basically forced or more focused on corporate finance, debt and equity models, or international finance, etc. But look at this from this point of view: who makes the highest financial decisions in this world? It's going to be households, right? And given the context that financial innovations are happening at a very rapid pace, households need to basically make different kinds of financial decisions, and it's getting more complex in nature. So therefore, there is a need to study this households' financial decision making alone, which is why way back in 2006, John Campbell has come up with this, coined this term, household finance, and later a lot of people like Anna Maria Luzzardi, Olivia Mitchell, Paolo Sodini, etc. from the world has basically contributed very high to this literature. What is this household finance? In fact, I would basically describe it in 2 minutes. It's basically the difference between a very normative question as to what people should optimally do and what are people doing. The deviations from what actually people should do and what they are doing is the mistakes which people do. Well, these mistakes could be 3 important questions in household finance. Why these mistakes happen? One could be from the demand side, from the people side. People do not have financial sophistication to understand what they should optimally do. This has been well done in the literature, other stuff. The second interesting thing is that from the supply side, given that people have lesser financial sophistication, what is happening with the supply side financial innovative products? Why are people less appealed to basically get and buy those financial products which are liquid in nature? And this basically is a very important factor, just because we are talking about low and middle income households, which naturally would put all their money into illiquid assets, let's say real estate. And finally, the question also points out that what is the institutional framework, what is the policy and regulations, which basically might influence people's choice to basically have financial products. In this context, Dvara Research and Dvara Foundation basically is working on these 3 core issues at a different levels. And I'm really happy that we have Ms. Bindu Ananth, who's been working on 3 important things. If you look at from the point of view of the first question, they're looking household finance research. They basically do what is Indian household doing? What is their assets? What are the liabilities? What is the level of financial sophistication? Is it well distributed or not? When you look at from the supply side constraint, and they try to address the supply side constraint by putting a different set of models to you in terms of Dvara Smart Money or Dvara Smart Gold or the Kshatriya Gramin financial services. Finally, when it comes to the addressing the policy and regulations, Dvara is basically working on the fact that once you have a new policy coming up within this age or regulations coming up which are very faster pace, how does it affect a customer is also being studied. So we have a person in midst of us which has been answering these challenges questions from Indian household framework. And we don't have a better person. That is what exactly the point is. Now over to you, Ms. Bindu Ananth. It's a pleasure to have you. I warmly welcome you to this webinar series organized by IIM Kozhikode PGP Finance. Once again, welcome.
Thank you so much, Professor Thomas. You really made my life much easier there. I think that's pretty much the first third of my presentation. But thank you very much for setting that valuable context. Thank you also to Soumya and Professor Jijo Lucas for inviting me to the speaker series. This interaction is virtual, but I really do hope to have an opportunity in the near future to visit your wonderful campus at IIM Kozhikode. So I know you've had this, been running this series, and you've had really some wonderful speakers. So what I thought I would do is to really focus on the household sector, as Professor Thomas very nicely described, and not just low income, right? So people like you and me, and really think about, and hopefully this is more interactive than me sort of speaking into my camera, but really think about how can the financial system add more value to the household sector, which is really at the end of the day the core beneficiary, right? So that is really kind of the main thing I will try to do here. There is a small but growing academic field called household finance that Professor Thomas talked about, John Campbell at Harvard, Professor Tarun Ramadurai at Imperial, closer to home, Professor Susan Thomas at IGIDR are some of the few people who I think are really doing outstanding work in this area. And hopefully some of the audience today is also doctoral students, alumni. It would be wonderful. I think this is really overall a sphere where I think India really should be in the lead. We've had a lot of aspects of development economics, etc., where much of the data, much of the field sites come from India. And the researchers, for a number of reasons, have been from outside India, done excellent work. But I think really in household finance, we are in the middle of all of this action, and hopefully we can produce world-class researchers as well. Today's talk, I know most of you are folks who are interested on the practice side. So while I may have a slide or two on research, by and large, I'm going to focus on how can we do more in the realm of practice. And just by way of sort of quick overview, it's been really an interesting, journey for financial inclusion, I would say, over the last decade. I have been closely involved with this field for pretty much the last 15 years of my career. And I think two dominant success stories that occur to me, there is obviously, as we speak, a lot going on in terms of fintech, and we'll talk more about that. But if you put the bar in terms of what are some of the initiatives that have really produced at scale, and I think in India that is an important lens. With the 1.2 billion population, you can't just have a few pilots. You want to think about what are the solutions that can scale to population size, as it were. And to me, those are really two. One is the entire sort of microcredit work, which is providing short-term loans, unsecured loans to low-income households. To give you context, there are roughly 10 crore microfinance customers. Maybe not unique. So if you take unique customers, that probably comes down a little bit, but by and large, that's the order of magnitude. which, by the way, is bigger than the number of mutual fund customers. So I think it's always helpful to think about India as having these sort of lots of dichotomies, and through the talk, some of this will become clearer. But of course, everybody is in that sense operating in the household finance realm. And the other, I think, big success story has been really at the other end of the spectrum, which is digital payments, particularly UPI. And I think we've really seen the value of that, particularly over the last few months, where it was important to get benefit transfers, etc., out to a large number of people through digital ways. And I think India is really a world leader when it comes. I think we are doing about 1 billion transactions or so a month, but that's really serious scale. So these are the two sort of and there are many more experiments that have gone on, but these to me really stand out. Happy to talk more about this later if there's interest. But in the talk today, I really want to make the case that there is a need for significantly more innovation, right? And not have the 2 success stories in 1 decade, but at least 10 times that size. And it is really my hope that many of you in this group today, in your avatar as future entrepreneurs or researchers, can really sort of contribute, and that sort of really is what made me excited about doing this today. So with that brief remarks, let me just try and get my screen sharing going and dive in a little bit. Okay. I hope this is visible, Soumya.
Yes, it is.
So as Professor Thomas said, household finance is now also an academic field. This is Peter Tufeno's definition. It's how institutions provide goods and services, how consumers make decisions. And there is that whole field of behavioral finance that thinks about why is there gap between what economic theory would predict as people do and what people actually end up doing, what lies beneath that. And of course, very importantly, how does government action, regulation affect the provision of financial services? So just to give you guys some motivation, if you're not convinced that this is an important topic, let me give you a sense of why we should think more about this. One is that, like I said, I think in the past decade, we've made a lot of progress on what we would think of as the inclusion front, which is a lot of people were really sitting outside the margins of the formal financial system. And one very crude metric of this is how many people own a bank account in their own name, right? So we've made dramatic progress on that front. Number of policy initiatives, but also work by banks. And today, roughly, my sense is about 90% of Indian adults own a bank account. 10% exclusion is still a lot in India because everything is a big number, but this is something that we progress a lot on. But worryingly, when you think about usage, which is to say, are you transacting this account, putting money in, taking money out, sending a remittance and so on, nearly half of these accounts are inactive. So think about that. We, did a massive sort of effort, spent a fair bit of money, but to us it seems intuitive that bank accounts are useful, in fact an essential kind of part of our life, financial lives. But almost half of those for whom accounts have been opened don't quite feel the same way. So there is something there, right? That's sort of worth understanding. The other thing, again, which Professor Thomas talked about very nicely, is that there is a persistent gap between sort of what theories think people should be doing. And again, here I'm talking about people like you and me, right? This presentation is not just about financial inclusion of poor people, it's about household finance, which is kind of a broader construct. And I'll show you more data around some of these, but people seem to be, you and me, folks like us seem to be leaving a lot of money on the table in terms of the choices we are making. Specifically, we know from research that there is a very high proportion of physical assets on the asset side of the household balance sheet. And on the liability side of the balance sheet, there is quite a bit of non-institutional source of liabilities. In simpler words, informal borrowing, expensive informal borrowing continues to dominate on the liability side. So what is going on here, right? I mean, surely we all know from all of our kind of work on asset allocation to fund separation, etc., to say that, ideally you need to have some combination of risky and risk-free asset in your portfolio, increase your diversification. So if you work for Infosys, don't put all of your wealth in Infosys stock, because then your kind of salary income is correlating with your income from financial assets. Yet we see a lot of physical assets going on here. The third thing is really around, if you look beyond credit, specifically to markets like insurance, pensions, very little progress. And so what's happening is that excuse me, people are using credit as sort of a band-aid for everything else. And I think one of the places where this is pretty clear is, for example, in health finance. We just did a seminar on this yesterday as part of a series that Dvara Research is doing on health financing reform. And one of the speakers really pointed out that India is an outlier in the sense that almost 65% of total health expenditure is out of pocket, which means that, we are paying people from our own wallet to purchase health services. In most, of course, in developed countries, but even in sort of who we would think of as peer countries, the number is not that high. There are more of what we would think of as pooled instruments, insurance, or tax-financed health delivery. But in India, 65%, and all of this has really come to the fore, I would say, in the last several months, where even middle-class households, again, we're not talking about poor people, but middle-class households, we've been reading in newspapers to say they've not been able to leave the hospital until the COVID bill of, 20 lakhs is paid. And if, paying 20 lakhs out of pocket, even for a fairly well-to-do Indian, is not a small matter. So we get a lot of bankruptcies at the household level because of the fact that you're financing things through credit that ideally should be more pooled in nature. Right, sort of your central limit theorem, that there are, unpredictable expenses in health, and particularly the tail events, the fat events, the one that is a significant multiple of your income, ideally should be financed through pooled mechanisms rather than out of pocket. Yet this continues to be very much a life challenge. And then finally, there is a whole set of specific issues around low-income households. And this is something at Dvara we spend a lot of time thinking about and working on. We have a financial institution called Dvara KGFS, which is actually a provider. So we operate in rural markets. And here the real issue, which I think there's not been a lot of work in household finance theory to understand this, is that most models assume the salaried individual. So you have fixed cash flows, but all of that understanding goes out of the window. And I'll show you some data around this when you're thinking about a household that has extremely variable cash flows. So if you think about a typical farming household, for instance, an extreme case, say, of a sugarcane farmer. Sugarcane is harvested only once a year, which means around Pongal time, you will get sort of your paycheck. And for the rest of the year, you got to manage that. It's a hard task. If I told many of you that, you're not going to be getting a monthly paycheck when you graduate, but just like once a year, believe me, that's going to stress a lot of you out, right? So there is an entire set of additional issues that we worry about when we come to low-income households, in addition to what I spoke about earlier. And that's made it very hard to kind of really integrate these households into the formal system. So clearly all of this matters for the household itself, no doubt, right? And it impacts the way they are able to manage risk, the way they are able to think about their future growth. But I also want to, because I know many of you are interested in regulation and more macro aspects, also if you think about it just from a pure, economic growth, efficiency of monetary policy, etc. If 80%, 90% of your households are going to be sitting outside the formal system, not responding to interest rate signals, then what even do we make of things like transmission of policy rates? That really assumes that people are within the system and they respond to signals, which is why some of these changes are in basis points, and you will see all of the hype and attention that is paid to every small change. A lot of this just presumes that people are in the system and people respond to those price signals. But I think one of the issues in the Indian financial system has been that, all we are seeing is a tip of the iceberg, and we have this whole group that is simply not participating. By the way, please feel free to stop me at any point if you have a question or a comment. I will keep an eye out on my chat window if that's the right place to. Or Professor Thomas, you can just interrupt me. So just to give you a little bit of additional data, let me check if this is the right slide. Yes, so I think one of the innovations in household finance has been, exactly like in corporate finance, to take sort of a balance sheet view of the household. And if you think about it, that makes sense, right? Because the way you would understand a firm and its finances is look at balance sheet for a snapshot, look at the P&L for profitability, and then look at cash flows for solvency. And those three concepts actually lend themselves very well also to households. So this is a tool that's been used, that is increasingly being used. My colleagues at Dvara Research also do this quite a bit. So this is to give you a little bit of just some snippets on the asset side, what is happening to household balance sheets. And apologies if some of the fine lines are not very clear. Let me explain to you what you're seeing. So the rows are, kind of an analysis by age. And that's important because in India, we have a fairly sort of young population. So helpful to keep that demographic sort of lens on. And the second row is by wealth quintile. So it lets us understand how does behavior change from the lowest to the highest quintile. And this column looks at participation in various financial assets. Participation is, just think about it as take up of a product, financial product or service. And the second column here is allocation, which means what is a share of portfolio. So it's kind of a value type notion. And each of these lines represents a different asset. So we have real estate, just staying with the top left quadrant, the green line is real estate. Then you have this orange line that's gold. And then you have durable goods and other financial assets. So one of the things that should really already jump out at you is that, across wealth quintiles, just how important physical assets are. So the average Indian household is allocating nearly 85% of its wealth to real estate and gold. These are, I think we talk about gold a lot, but I think don't recognize how important real estate is as part of portfolios. And there is some kind of, fungibility. So as incomes increase, real estate starts to substitute a little bit for gold, and real estate starts to dominate. So there is some kind of trade-off there, but still it's stunning that even for a median household, 85% of assets is physical. This is something that, and one would say, what is the problem with physical assets? I think many of you know that from financial theory, We worry about illiquidity. We worry about, sort of correlation, particularly land. So if you think about a farmer who is investing her spare money in terms of buying agricultural land in the village, it's exactly like the Infosys person, buying a lot of Infosys stock. It's the same issue of concentration of risk, right? And so in general, I think just financial assets is such a small sliver. And if you think of all of us bankers, mutual fund people, securities market people, we are all operating with this sort of tiny sliver of 5% of assets. Imagine how exciting it would be if you could really sort of expand the size of that and to really, become more salient on the asset side of balance sheet. So that's kind of one fact, something to think about and be conscious about when we think about households. The other thing is on the liability side. A surprising kind of issue, which the Tarun Ramadurai committee really also pointed out that India is an outlier, is that there is significant reliance on unsecured debt from informal sources. And while that changes a lot, again, the setup of the graphs is the same in terms of rows and columns. So if you look at the bottom right kind of graph, which is the kind of value metric by wealth quintile, this is a sharp descent, which means that this is the unsecured loan line, for example. So this is what percentage of your total liabilities is accounted for by unsecured loans. Clearly, you can see that as you go from the poorest groups to the richest groups, it does decline quite sharply. But even for the richest quintile, even for the top quintile, it's still a good 35% or so of borrowings. How does one make sense of this? I mean, informal is many things. It's friends, it's family, it could be chit funds. So instruments like chit funds, unregistered chit funds are pretty popular as a kind of borrowing tool among even businessmen and SMEs. That's kind of I think a really interesting sort of fact from this. Let me not go into more detail here in the interest of time, but I think for those of you interested in these issues, I think deconstructing the households, looking at the balance sheet view gives, I think, very interesting insights. The only other thing I'll point out again is, and again, apologies for the small font, is that we have mortgages somewhere here. Yes, this green line is mortgages. And again, this gives you a little bit of a sense of even for the, if you take a median household, let's look at participation rates, it's just about 4-5% have a mortgage. And these are large, well-developed markets in other countries. Of course, those countries have higher income than ours. If you think about the US, for instance, mortgage is such a dominant part of the financial system. In fact, a lot of work on household finance that Campbell, Tarun Ramadurai, etc., very much in the context of mortgages. So for example, they ask questions such as, why do people leave money in the table in terms of not refinancing their debt more aggressively? So those are, as you can imagine, very first world questions. Here we are thinking about less than 10% of the population having even access to mortgage. So our issues tend to be much more on what we think of as the extensive margin. How do we get more people to participate in these markets and instruments, right? So I showed you the asset side, I showed you the liability side, and just some facts for you all to think about. And I want to take a few minutes to talk about kind of the low-income household specific problem, which I alluded to earlier. And again, this graph that you see on the left, what is it? It's just the monthly cash flows of a typical household. This is from some of our field research. Each blue dot represents monthly income, right? So January through December, this is the income that was received by this particular sample household. Now, obviously, the first thing that jumps out at you is it's all over the place. If it were a salaried household, it would just be a straight line, right? It would just be, wherever the level was, it would just be a straight line. And maybe you get a little bit of a bump around bonus time, but your monthly paycheck doesn't move around that much. And so the other interesting thing, so one is just absorb the fact that, 500, 600 million people's cash flows actually look more like this than a straight line, and it has big implications on financial systems. The other is, if you do think about the straight line is the poverty line, right? So that's very interesting because it sort of cuts across the center. Now, the question to you would be, is this household that we are seeing, in aggregate, they are not below poverty line. They were not what you would think of as a low-income household. But interestingly, if you look at a monthly kind of picture, and depending on which month you meet this person, they could be below poverty line. So one of my favorite professors in this field, Jonathan Murdoch, I think he uses a very interesting analogy of goldfish. And he says that, averages are very misleading, as we all know. So it's not important that on average, the goldfish has enough water in its bowl. If there's not enough during a particular stretch, the goldfish could die. So very similarly, I think, particularly when it comes to low-income households, averages are very misleading. And therefore, when you think about design of financial products, and I hope many of you go on to innovate on this, you take a household like this and I say, I'm going to give you an EMI. I wish this were a more interactive session. I would have asked you guys to speak up at this point. But what does an EMI do on a picture like this, right? The EMI is actually a flat line. So your inflows are all over the place, but an EMI imposes a fixed liability through the 12 months. So in a way, it sort of exacerbates your volatility. It makes you worse off because in the month, let's say February, when your monthly income is 4,000 rupees, and let's say your EMI is 3,000 rupees, in that particular month, you may be left with not even enough to feed your house. So these are really important issues, and you can miss this if you think about much of the country being salaried. And this graphic on the right really just reiterates that point to say that to us, most of us, we are going to be salaried workers, or some of us are going to be entrepreneurs. But the salaried group is in the country very small, and obviously within low-income households, it's tiny. Bulk of people are self-employed, casual labor, agriculture, non-agriculture. So this is a central problem that we face. So those were all just to give you guys some motivations around what makes household finance interesting, what makes it challenging for those of us who are looking to innovate in this space. And by and large, the themes of household finance research, just to give those of you who have a research bent a bit of a quick overview, and my colleagues have a nice way of describing it. They say kind of cover the three questions: the what, which is to say, what are actually households doing? How do they borrow? How do they save? How do they invest? I think that's really interesting to understand. It's new knowledge, worth understanding a lot. For example, there are a bunch of informal strategies. I've done a lot of my work in rural Tamil Nadu. Just to give you a quick example, one of the things I've been fascinated by is this ritual called the Virindu. The Virindu literally means feast in Tamil. So what it means is that if there is a particular house in the family in the village that has a lumpy expenditure, let's say they need to pay college fees, or they have a marriage in the family, they will throw a feast. So it's roughly the equivalent of the US fundraiser. Actually, that's the closest analogy. Everybody has to show up. It's not one of those things in which I think you have a lot of free will. You show up and then you actually, give the family some money, and they throw a feast, of course, to make sure that there is something in it for the others. But the real purpose of it is actually to pool this lump sum, because it's a hard challenge for people to come up with, particularly those who don't have access to large size loans, etc. So the Virinda is a beautiful informal informal mechanism. And those of you who are budding anthropologists would be interested to know that households actually maintain very detailed trackers. They have registers, and I've seen many of these in which they say, okay, so-and-so person came to my viranda, gave me this much money. And there is a very clear expectation of reciprocity. So this is not a free viranda, not a free meal in that sense, but when the other family has something in the future that they need to raise money for, you better show up and you better contribute an amount that is roughly similar to what they gave you, which is why account keeping. So, I mean, there's just so many fascinating examples of how communities, households are managed in the absence of formal financial systems, because people need ways, right, to manage consumption. So I think it's fascinating to document the what. I think there's a deeper set of research questions around why, which goes one step beneath that and says, why do people behave the way they do? And I would say in this space, in household finance in general, in particular, when it comes to low-income households, we're very quick to pronounce the verdict of irrationality, to say, oh, people are not, saving enough because they are myopic, or, they're just silly about long-term returns. And you will see, therefore, there is big investments and a lot of money being pumped into a lot of regulatory focus being paid to things like financial literacy, which effectively is saying that you don't understand money, so let me teach you how. But we really challenge the notion. I mean, we work closely with households, low income, middle income. People are really sophisticated about their money, and often the apparent behavior is in response to a deeper failure of the market. And so it's really interesting to sort of document why do people behave the way they do. One of the examples that will always stay with me, and let me leave it with you as an anecdote. I used to be, my first job in ICICI, a relationship manager for microfinance institutions. And it was an amazing first job because it was early days for the sector. Many of the big players now, the small finance banks, were at that point fairly small players. And I used to love doing the customer visits and understanding what are people doing, just, as a curious young person starting out her career. I met this customer once who, so, our standard question as bankers is, acha, kitna paisa liya hai? Kya karne wale ho? And most people will tell us, gai karidna hai, because there are a set of expected answers that you give the banker. You are not really going to tell the banker the whole truth. So we're kind of used to the pre-programmed answers. But one customer I remember told me that I am taking this loan from Spandana. I think it was 8,000 or 10,000 rupees. And she said, I'm going to put it in a fixed deposit. Okay, so again, I wish I could see your guys' faces, but what is mind-boggling about this, and again, from a theoretical perspective, makes no sense at all, because borrowing from Spandana costs, at that point, it was 30% plus. And the best case scenario on your fixed deposit is 9 or 10%, which means you have a negative carry of at least 20%, right? You are, just by fact of borrowing and, kind of putting the FD, you're losing. And so that really blew my mind. And, as I was trying to understand it, the customer explained to me that she was not thinking about price. That was not, interest rates. She was aware, of course, of what she was paying Spandana. That is not a problem at all. But her point was that if I had to save up this 10,000 rupees, 100 rupees at a time, it would take me a long time. And there are lots of pressures because of which, if a kid asks me for money to spend on like a cycle, hard for me to say no. And so this is deep kind of, I think, behavioral insight to say, producing that lump sum is easier through an act of borrowing, even if the price that you pay is a negative carry of 20%. So there's a lot to be done in terms of understanding why. I should move faster. And the final is kind of the how part of it, as my colleagues call it, which is really what happens when supply and demand interact, what frictions are caused by regulation. And there are lots of examples of both intended as well as unintended consequences of regulation, that for sure shapes the way households behave. For example, many of you, I'm sure, being people in this particular time are interested in crypto and so on. The regulatory response of an outright ban, and I believe a law is going to come to actually make sure that this matter is settled, means that all of that activity is pushed into the informal realm, and maybe these are assets and activities in which some learning curve is interesting because we do things, we make mistakes, and it would be legit for regulators to say that we want to protect a certain category of customers. Customer protection is a very important objective of regulation, and therefore we want to make sure that they don't incur losses because this is a early market. But an outright ban. I think therefore, I think regulation matters a great deal, both in positive as well as negative ways. I'm going to skip this particular slide. We'll talk more about it as we go. Summary is that household decisions are influenced, as you can imagine, both by demographic, behavioral, but also supply side. And I think people are quick to assume that all the issues are on the demand side. I've heard people tell me that, people don't buy insurance in rural areas because, they don't understand risk. They're just living for the here and now. And there is obviously deeper paternalism towards the poor, etc., loaded in those statements. But once I started getting deeper into our work, insurance is an important part of what we do. Claims settlement in rural areas, because you will find that agents are very aggressive about selling insurance, LIC agents. That's, I think, a universal fact. And it's often somebody in your family. I think many of us have been sold a dud insurance policy by a well-meaning aunt. You have the policy and then the agent disappears. The agent is now focused on the next set of customers. The moment of truth is actually claims. And so when there is an issue, whether it's an accident or a death, and claims in a rural context, etc., taking easily anything upwards of 6 months. And so, you tell me, is the fact that there is low participation in insurance now, is it irrational demand side behavior? Or is it just, is it calling the bluff of the supply side to say, if you're going to sell me something that basically doesn't pay out when I need it, why pay you the premium, right? So I think it's helpful to really understand that it's often both going on, not just demand side. Let me jump to talking about innovation a little bit, which I'm sure is what you guys are really interested in. I think when we talk about innovation, typically we jump immediately to technology. And of course, tech is an important part of it. But, in our work, we found that it's helpful to take a broader view and to say innovation to address all of the problems we talked about needs to have a product, process, and even regulation. I mean, for sure, regulation is not likely to lead innovation. It's often always just catching up. But there's a lot that regulation can do in terms of creating an enabling space. Let me just give you some quick examples. And Professor Thomas, how much more time do I have? I want to leave enough time for questions.
You're 10 minutes questions. So somewhere around 8 to 9 minutes.
To wrap up?
Yeah, 8 to 9 minutes. And maybe we can, you can take around 12 minutes and then we can sum up the questions, let's say in 8 to 10 minutes.
Okay, sure, let's do that.
Yeah.
So this is work by one of my colleagues, Beni Chug, who took all of the fintech kind of work out there, and her paper is available on our website. Those of you interested should take a look at it. And she really sort of mapped to say what's going on right now, what are the various, and she was able to map out 14 distinct models. Some are on the credit side, some are investments, some are distribution, some are kind of algorithms. So there's a lot going on. It's an amazing time to work in India, in finance, in household finance, because we are really leading, I would say, the world in terms of some of these issues. It also creates a lot of headache for regulators, as you can imagine, because these cannot be neatly categorized into, banks, insurance companies. So for example, what do you do with somebody whose algorithms are being used by a bank to make its credit decisions? The bank itself is regulated, but if you ask the bank, Acha, on what basis did you make this disastrous loan? They'll say, I have no idea. I use this black box, and this black box of algorithms was given to me by this, kind of fancy tech company. But that tech company sits outside the banking kind of system. So I think, fantastic innovations, but also interesting challenges for regulation and customer protection. I want to make a plug here. I started by saying that, all of you should play a bigger role in terms of innovation. There's so little in terms of smart products in this market. I mean, if you look at other markets, FMCG, consumer electronics, I mean, the innovation coming out of there is mind-boggling. But if you look at it, essentially, what are we delivering in financial services? It's pretty basic things, right? For example, we don't have a way, every other month we hear about floods, landslides in Uttarakhand, so on and so forth. It is systemic risk, and we know that there are global markets that cover for catastrophes. Yet it's really hard to buy, for example, a catastrophic bond that protects either a business or a household or even a state government against some of these risks. I mean, that might seem to you like a high bar for innovation. Let me tell you, we don't even have, for example, lending products with flexible repayment schedules. And we already talked about variability of cash flows. If you think about a farmer, what sense does it make to give a farmer an EMI structure because she doesn't have cash flows for 5 or 6 months of the year? Yet it's been somehow a very great challenge to figure out how to do repayment schedules that are matched to the cash flows of the customer rather than just what is convenient for me. So I say at the bottom of the slide here, there is a dangerous myth of simple products. You will hear often in policy that let's just make sure that we cover most of the households with the basics. Let's do simple products. And the key question that we must ask there is simple for who, right? So a fixed EMI loan is very simple for the bank to administer and for its technology to deal with, but it creates actually a lot of complexity as far as the customer is concerned. Similarly, I think there is a lot to be done in terms of process innovation. We are still pretty much reliant on brick and mortar, expensive ways to, access services, also expensive ways to get redress if something goes wrong. And surely there's a need for much more focus also on the process side. One thing as MBA students you will appreciate is, I think, there's a big kind of concern around cost structure. So some of the work that we had done at Dvara Research was we took, a 10,000 rupee loan and we said, how much does it cost? Not risk, not anything else, just operating costs. How much does it cost across a private sector bank branch, a public sector bank branch, a microfinance institution, and so on. And these numbers are very high. So best case is an MFI whose operating costs are somewhere, between 10 to 12%. For a bank branch of any kind, private or public, these numbers are, 25% and upwards, which means that, your loan is unviable from the minute you have conceived of it, because there's no way you're going to recover that sort of yield, right? So, and why are these so expensive? A lot is to do with the way we do it. Bankers still love paper, digitization in that sense. A lot of the infrastructure has been built with India Stack and so on. But in terms of really rethinking processes, reimagining it for a digital world, I think we are still not there. And the last point, some of you may be interested in regulation. I think is this not thought about enough? And I know you had some wonderful speakers, Dr. Acharya, Dr. Damodaran, kind of think about this issue with you guys. But it is important in a country like India to, even if the regulator is not leading the charge, to create that sort of enabling. And one place where we've done really well, I think, is in terms of public infrastructure for financial services, in which I count things like UPI, India Stack. There's this new development called the account aggregator, which really lets you share your data in a secure way with consent across providers. So I think India is a leader here on, and that's a wonderful public good, because if you have high quality infrastructure and you have decent competition rules around that, it really opens up the field, like we've seen in UPI, for a lot more participation. And I think that there is a non-infrastructure part of regulatory innovation, which is really about thinking through how do I kind of build a space? How do I create more participation? For example, we think a core role for the regulator has to be around customer protection. Why do people love gold so much? Going back to that, right? It's something that is tangible. It's something that you can feel. If you have a problem with it, you can figure it out. Many customers tell us that my problem with a mutual fund, etc., it's not that it's variable in terms of returns. A farmer is very attuned to variable returns. That's the life she lives in. But the problem is, if something goes wrong, who do I speak to? In some sense, then you're completely on your own. Similarly, I think adoption of digital platforms is going to be a lot driven by being able to create confidence for people to transact on these platforms. With that, let me pause, because, I always love to hear more from you guys. And I hope some of this, piqued your interest, and at least some of you will go on to build careers in household finance. Thank you, Professor Thomas.
Thank you so much. As a person who's been doing some budding research in household finance, we have a very few, 2 or 3 people as a doctoral student who works in household finance. So it was a very inspiring talk, and exactly it has basically opened a lot of dimensions. But let me basically go through some questions which the PGP finance students have come across. So one question is from Ajit Bansali. Well, I'm going to basically combine Ajit's and Aditya's question together, which is more or less having the same framework. So one thing what is it? Abhijit is asking is that saving rates have actually come down in India. All right. And but on the other hand, indebtedness has gone up, and this indebtedness is almost mostly from the point of view of the informal loans, basically. So is it because people find immediate gratification, though they don't want to basically smooth consumption function, they don't want to have an intertemporal consumption function, they want to, they will have immediate gratification, let me use the consumption right now. Is that the change in the people's behavior, or is it something else? Why is that the saving rates have gone up compared to our parents' time? And why is that Aditya's question is that why is that there is this persistent problem regarding indebtedness and especially from informal sources?
Right. No, very good question. And, just to clarify, I think both savings as well as borrowing, both are strategies for intertemporal, right? I mean, in some sense, in both, if you think about, Professor Merton is the one who's done a lot of foundational work on functions of finance. And really the functions of finance are just 2 or 3. You have 100 products, but all of them, are either smoothing consumption or moving resources across what he calls state spaces, which is really risk management. So both savings and borrowing are moving resources across time. So my father built his first house when he was 45, and he sort of saved up. He didn't take a loan, he built it. I bought my first house with a mortgage when I was 25. But neither is, in some sense, my father kind of saved up and bought his house. I, kind of, used my future income, and I, paid it back only recently. So both are intertemporal strategies. I think then the relative magnitude is a lot to do with what else is happening in the environment, what is the opportunities available for, savings, what is happening on the supply side, what are my expectations about the future, right? Around now, for example, savings rates have gone up because there is a precautionary motive and people are not sure what's going to happen in the next few months. So I don't think there is sort of a simple kind of thing there, but more to say it's worth tracking and also looking at how specific indicators are moving. In borrowings are high, but it's not, in that sense, excessive. I think what we worry about more is why is it still stuck in the informal system? Why is it's a sign of failure that we've not been able to get people to borrow from more cheap and, in our view, at least reliable sources.
All right, thanks for that. The second question is something regarding microfinances. Even though microfinance has got the bad reputation because it's highly expensive, it's exploitative in nature, but do you still believe microfinance is the best way to achieve financial inclusion in the bottom of the pyramid?
Okay, so this is a whole new seminar topic, but I want to challenge this notion that microcredit has not been useful, partly because I have very much been a part of this field for a long time. And what has microcredit done? It's really not, so don't compare it with the loan that you get from a bank at 14%, 13, 14%. Think about it as a substitute for informal borrowing, which if you go to a vegetable market, you will see that it's 10% a day. And so microcredit has created a positive substitution, and all of that saved interest very much is additional savings for the household. I think the real issue, if anything, has been that from a product perspective, it's a little bit of a single trick pony, right? So all of microfinance does is this 15,000 rupee, 20,000 rupee loan payable in fixed installments. And it has that whole group structure for which Professor Mohammed Yunus won the Nobel Prize for that insight. And it's very efficient as a risk management tool. But for many people, the group is onerous to say, why should I guarantee, for me to get a loan, why should I guarantee 4 other neighbors' borrowings? So it's clunky, it's awkward. But to my earlier point, I think it's worth recognizing that in a country which has had so few successes, this is one tool that has actually reached 100 million people. Not a joke, guys, to achieve that kind of scale. And if it was so useless and so predatory, I don't think 100 million people would have, taken it.
All right. The next question is that given that we have, why is it the insurance penetration has not reached, high levels? I mean, we talked about the, dominant stories right now. And why is that, insurance, is there kind of micro insurance has been in the market, but it's not a very successful story till now?
Not micro insurance, not macro insurance, right? Which is why some of these are common problems. It's not problems of poor people. We have a very, very tiny insurance market. And you specifically think about, to take an example of health insurance, it's something that is salient. We all worry about a lot. So one is on the supply side, I think you're only now starting to get some real action. But there is a lot that's broken in terms of distribution. So today, most people would get their health insurance from their employer. So when you join a company, there is some, likely some contribution that they do. So distribution is not yet great. I think fintech will change a lot of that, where you can start to buy insurance directly on the web. But again, technology will solve part of the problem, but I still think that you need to figure out the problem around advice to say, what kind of insurance should I buy? How much cover should I buy? Should I buy 5 lakhs? Should I buy 50 lakhs? What is most suitable for me? So I think there will be an ongoing role for good advice, but today many of those pieces are missing in our market. Opportunities for you guys to build.
which came up in my mind, and it's been there for some ages. Now that you've opened up the cans, now you've openly admitted that basically you have indebtedness, and then indebtedness is more or less coming from the informal markets. We're not able to basically pull these people to formal markets. That's one of the issues. Now, is this because you came across something called as financial literacy or financial sophistication, which is not the real idea? But is it because financial literacy cannot be increased beyond an age is through financial education? If you basically give financial education to younger households, I mean younger, not households, younger kids, at least the future generation would be having a much better demand response. I know what to take. I know what is a financial decision to make. And does Dvara basically work on any of this research on this level? Because there are some research which has been done in the Western side with Robbie Alex, etc., trying to find out financial literacy's instrument is what is my max score in 10th, or what is my language score in 10. So if I improve, if I make some intervention at the age of 5 and 6, I could basically improve the next generation's ability to make much better financial decisions and achieve financial goals at some point of time.
Right.
One of the
no, I think surely there is some merit in what you're describing, particularly younger generations. So rather than take a boiling the ocean view of things, and I think also the tools that we've used for financial literacy, really terrible, classroom sessions. Cannot imagine a more boring thing than sitting in a classroom hearing about interest rates on fixed deposits, right? So and these things, I think Anne-Marie Luzardi's work has said that these things don't stick. Even if you got it, the minute you walk out of the classroom, it's all kind of disappeared. So we've actually, Professor Thomas, taken much more of a view that in medicine, for instance, in healthcare, for instance, you don't take a view that you have to be a good patient, you have to be educated on what antibiotics make sense to you. You actually need a far more qualified provider side on the, who can tell you, okay, if you are a 25-year-old with a young family, what should be my asset allocation strategy? So today, part of why the financial literacy conversation is uncomfortable for me is that it feels like you're putting a lot of the monkey on the back of the consumer, whereas the provider is selling you tier 2 bonds, ULIPs, and saying, well, you should have understood it. You should have read the fine print, right? Your problem. So finance has a lot of information asymmetry, and I think we should think about this jointly. There must be financial education, but not kind of let providers off the hook in terms of what is, standards that they must follow.
All right. Maybe the final question of the day. That's it. Financial services is digitizing at a rapid pace now, but the penetration seems to be low. What is your steps? She's already discussed this, but what are the steps which we can ensure, given that the digitization is going very fast, given that the regulations are going very fast, but still you see the penetrations at very low level? How do you basically does it understanding the psyche of Indian household? Will it help, or basically, as you said, redesigning our products, which makes it more accessible to the household? Which way it works much better to improve the penetration?
Right. No, I think so. One, if you break it down a little bit, think about payments. Payments has been transformational, right? The adoption of digital payments, yes, it still remains largely an urban phenomenon. And so and it's really for people who have smartphones and so on. But, we have 300, 400 million people with smartphones. That's not a bad number to start with. And the rest of the country is not sitting watching. As soon as they can get enough money together, they're buying a phone. So I think on payments, you are seeing, and we have a nice, infrastructure there. But I think the real challenge is much more on the other fronts. So formal credit, insurance, investments, you're starting to see some play there. But again, I think to really get to adoption, we do have to address things such as, how much confidence can we give the customer? Is there enough infrastructure? If you don't have internet in Kashmir, but you say digital financial services is the future, how is somebody supposed to transact? So I think there's a responsibility to ensure continuity of infrastructure. And it can't be on now, off now, because then people are going to remain with cash. So I think we need to think about this issue more broadly than just a tech problem.
All right, wonderful. I think we'll have to basically stop it because we are well ahead of time. We have 3 minutes. Let me just conclude. Once again, thank you so much for this inspiring webinar. And most of the PGP students might also think about now, if they want to be an entrepreneur, well, let me basically design some financial products because the products are too simple. Let me use my brain down there, rather than basically working off for a corporate asset valuation model, basically, right? So I hope this is one eye-opener for all of you. Let me basically conclude this webinar series. We had a great number of webinar series, a varied number of professors, practitioners have spoken to you. I believe this is going to continue. Professor Jijo was mentioning it. We should have another set of lectures which is coming up very soon. So once again, thank you every speaker, and especially Ms. Bindu Ananth being here and helping us out to understand what is the nature of Indian household finance industry and what can be done for the future. What are the possibilities for the young kids down here as PGP students? How can they contribute to their Indian household finance? Okay, now I call upon Soumya CB basically to deliver the vote of thanks, and then thank you once again. Have a great evening.
Thank you so much. Good luck to all of you.
Thank you, ma'am. That was a very insightful session. And if I may add, on behalf of the entire batch, we'd all be very aware of the dangerous myth of simple financial products, especially as you mentioned. Thank you so much for spending time with us and sharing all of your insightful thoughts. And we hope to get the chance to meet you on campus someday. Before we close the session, I'd like to thank Professor Jijo Lucas, the chairperson of PTP Finance, Professor Ashok Thomas, and all the faculty members for all of their support for making this series the success that it was. And lastly, I'd like to extend my gratitude to all the students for all of your enthusiastic participation in today's session. Thank you, and I hope you all have a great evening.
Thank you so much once again. The session ends right now, and that's it. So Ms. Bindu will catch up sometime later. There's interesting conversations happening, maybe over an email, basically. Thank you so much. Bye.